Hello, I'm April Brown with Zelken Financial Services, LLC, and I'm back with the tip, today's illuminated point. So today I want to talk about an article that I read from two gentlemen. I think they're two gentlemen. I hope I'm right on that. Ernest and Young. So it was recently published study from Ernest and Young in which they made a case that taking income from permanent life insurance, which they actually use whole life insurance, and we'll talk about that later, and annuities in retirement can create a better outcome for investors. So let's dive right into the study and explore the methodology that they used in their analysis. So for starters, Ernest and Young compared 5 different retirement strategies. 5. The first strategy, which is utilizing investments only, which is basically that's it. They only use investments. And so the investor uses a mix of only stocks and bonds. The investor follows the Morning Star, which is a magazine that keeps up with stocks and bonds. They moderate and gilt pass asset allocation strategy with an annual rebalancing, and the investor contributes to qualifying plans up to the IRS's contribution limits, and then saves the taxable bucket, or they save it into the taxable bucket after the limit is reached. So that was the very first strategy. The second strategy that they used involved investments in term life insurance under this approach. So the investor purchases annual renewable term life insurance for legacy protection until the age of 65. And when they plan to retire, the rest of the investors' assets are allocated for investment purposes. The third strategy is involving permanent life insurance. That's the whole life piece that I was talking about, and investments. So the investor allocates a portion of their assets to permanent life insurance premiums and allocates the rest to investments. The fourth strategy is they call for a deferred income annuity, a DIA. That's what I'll use the acronym for. And so with an increasing income potential, this strategy entails allocating a portion of the investor's assets to acquire a DIA with increasing income potential, and the rest actually goes to investments. So the final strategy, the fifth one, is combining strategy 3 and 4. So the investor incorporates a permanent life insurance with the DIA with increasing income potential. And it's important to note for this strategy where they included permanent life insurance along with the DIA with increasing income potential. And so these insurance products were considered part of the fixed income allocation. So in other words, they considered life insurance and annuities as a bond replacement, because we talked about the investment strategy had stocks and bonds. So as they reduce the allocations of the bonds in this investment, so they actually reduce the allocation of the bonds investment in this portfolio. One other note to think of or to understand is they use permanent life insurance in retirement. So I just wanted to make one kind of particular point about this as a volatility buffer. So you'll hear about that. And if you get a chance, read the report. It's pretty interesting. So the volatility buffer, this is actually described by a gentleman named David McKnight in his book, The Volatility Shield. So what it means is that they assess the cash value of the life insurance to pay for lifestyle needs during the period of market volatility. So when the market is down, they pull money out of the life insurance policy. So this allows the investor to avoid having to access their investments. So when they have fallen in value, their investments, this gives those stock market assets an opportunity to recover before they make further distribution during their study, meaning they don't take any more of the money out of that asset allocation or the investment. They ran 1,000 Monte Carlo comparisons, and there were parameters that these were the parameters that they used in order to run those 1,000 Monte Carlo comparisons. So first, with the goal of measuring sustainable income as a wealth to heirs for each scenario, contained a time series of interest rates. They did inflation rates, equity returns, and bond returns across the planning horizon. And so when calculating retirement income, they applied ordinary income tax rates. They applied federal and state to withdrawals from the qualified assets. The DIA income with increasing income potential with the permanent life insurance. And they assumed that the investor's withdrawals, the cash value up to a basis, and then takes loans thereafter, each income scenario sustaining about a 90% probability of success or better. So what they did was they did, I think, a couple of couples, but we're just going to talk about this one couple. So the first comparison in the fictional couple of Mike and Courtney are 25 years old. They have about $80,000 of household income, and they can save up to 20% of their annual salary, and their life expectancy is 70 years old. So they run about 10 different comparisons. So that's why I said you probably need to read it to see what, because they've got all kinds of, graphs and that kind of thing. And so I don't have the graphs with me on this. So the breakdown of what they did in reference to the 10 comparisons goes as this. So it's the permanent life insurance plus the investments strategy actually outperformed the investment only. And they also had the term life plus investment strategies. So they didn't do as well as the PLI plus the investments. So the PLI tends to provide a superior return over a fixed income in the long run scenarios, while the term premium acts as a drag on the portfolio's performance. So the PLI loans act as a buffer against market volatility, we talked about that, as well as improving returns since the investor did not have to sell or realize any losses in their investment. With that said, the integrated strategies that they have, because like I said, they had 5, were more effective than the investment-only strategies. And so with varying allocations of permanent insurance, deferred income annuities, the DIA, with the increased income potential, and investments, the results suggested that the investment-only approach is insufficient from both an income perspective and a legacy perspective. And so the strategy that provided the greatest combination of both the income and wealth was the final strategy. It included 3 and 4. That was the final strategy of both. And so there are 2 observations about this study that were interesting to me that, as I was reading this. First of all, the permanent life insurance policy used in the study was whole life insurance. Not a fan of. Because of the loan provision, the study notes that the loans were taken out in retirement for the volatility buffer strategy, but had to ultimately be repaid back out of their investment portfolio. And the reasons these had to be repaid back was because, one, the arbitrage on the loans would have eaten up the cash value, and the possibility of even bankrupting the policy and receiving that kind of phantom tax bill from the IRS. If they had actually used an index universal life policy, an IUL that I'm always talking about, in the study instead of whole life, they could have shown a higher rate of return and possibly even made 2 to 3% higher. And this would have also provided a guaranteed 0% loan provision for the volatility buffer concept. So in other words, they could have taken a tax-free and cost redistribution from their life insurance saving money on interest payments and avoiding the potential phantom tax bill from the IRS. So this would have helped further preserve their assets and help even provide greater income and wealth to their heirs. So the broader conclusion of this is that allocating 30% of your assets to permanent life insurance, really IULs, and 30% towards annuities, which provide a guaranteed income. We talk about that, where you buy it and you provide yourself with a guaranteed income. I think it's a sound plan. However, you have to utilize IULs, which would have further improved the outcome over time. So the second piece of this, because there are 2 things, is the tax rates used in each of the scenarios were based on today's taxes. What would have been really cool is if they had done a scenario where they showed tax rates 20 years down the line. And so the tax rate's actually doubling over time. And then they would have found that the alternative of the 30% life insurance allocations would have pulled even further ahead of the investment only scenario. So with all of that said, it was a pretty interesting study. I think it gave validity to the reason why life insurance, IULs are important. Insurance planning is important in your retirement planning, period. It just is. If you want to know any further or you want to know more about it, the actual article I got, or where I got it from, was called The Benefits of Integrating Insurance Products into a Retirement. I'll repeat it again. Benefits of integrating insurance products into retirement. Ooh, it sounds so much better. So that's where I got it from. And, we'll throw it on the, throw it at the bottom so y'all can see all that. But that was pretty much the article. So I hope you got something out of that. Please go read it. I am April Brown with Zelken Financial Services, LLC. Until the next time, have a great day.